Hook. Did you know a company can report millions in profit and still go completely bankrupt? It sounds impossible, but it happens more often than you think. And the reason almost always comes down to one thing: cash. Today we are going to break down the statement of cash flows, the financial statement that tells you the real story behind a company's money. By the end of this video, you will know exactly how to read it, what its 3 sections mean, and why it is arguably the most honest document in all of financial accounting. Section 1. What is the statement of cash flows? Let's start with the big picture. The statement of cash flows is one of the 4 major financial statements, alongside the income statement, the balance sheet, and the statement of retained earnings. But here is what makes it special. While the income statement uses something called accrual accounting, which records revenue and expenses when they are earned or owed, not when cash actually moves, the statement of cash flows cuts through all of that and shows you the actual cash coming in and going out of a business during a specific period of time. Think of it like this. Imagine you sold $1,000 worth of products on credit. Your income statement says you made $1,000. But if that customer has not paid you yet, your bank account has not changed at all. The statement of cash flows would show $0 received. That gap between profit and actual cash is exactly why this statement exists, to show the truth. So here's the question that should be forming in your mind right now. If a company has positive cash flow, does that automatically mean it is doing well? Hold that thought, because the answer is more complicated than you might expect. Section 2. The 3 sections: operating, investing, and financing. The statement of cash flows is divided into 3 main sections, and each one tells a different part of the story. First is operating activities. This covers cash generated from the core business. Things like collecting payments from customers, paying suppliers, paying employees, and covering day-to-day expenses. If a company is healthy, this number should generally be positive. It means the business itself is generating real cash from what it actually does. Second is investing activities. This section tracks cash used to buy or sell long-term assets, things like equipment, buildings, or investments in other companies. A negative number here is not necessarily bad. It often means the company is spending money to grow, buying new machinery, or expanding operations. A startup, for example, might show heavy negative investing activity because it is building its infrastructure. Third is financing activities. This is where you see how the company raises money or pays it back. Did they issue new stock, take out a loan, pay dividends to shareholders, pay off debt? All of that shows up here. Positive numbers mean money is coming in from investors or lenders. Negative numbers mean the company is returning money to shareholders or paying back borrowing. Add all 3 sections together, and you get the net change in cash for the period. It is that simple in concept. But here is what makes it fascinating. What happens when one section looks great but another looks terrible? Stay with me, because we are about to explore that. Section 3. Direct method versus indirect method. Now we need to talk about how companies actually calculate and present the operating section, because there are 2 ways to do it: the direct method and the indirect method. The direct method lists out every major category of cash received and cash paid. Cash received from customers, cash paid to suppliers, cash paid to employees. It reads almost like a checkbook. It is intuitive and transparent, but it requires more detailed record keeping, so fewer companies use it. The indirect method, which is actually the more common approach, starts with net income from the income statement and then makes adjustments to convert that number into actual cash from operations. These adjustments account for things like depreciation, which is a non-cash expense that reduced your reported profit but did not actually take any cash out of your account. They also adjust for changes in working capital, things like accounts receivable going up or inventory going down. Here is the key insight. Both methods arrive at the same final number for cash from operating activities. The difference is just the path they take to get there. Most investors and analysts actually prefer the indirect method because it shows you the bridge between reported profit and real cash. And that bridge reveals a lot about how efficiently a company manages its resources. Which brings us to an interesting question. What does it mean when a company's net income and its operating cash flow are moving in completely opposite directions? Section 4. Reading between the lines. What cash flow reveals. This is where the statement of cash flows gets really powerful. When you know what to look for, you can spot red flags that the income statement simply cannot show you. Consider a company with strong net income but declining operating cash flow. This could mean accounts receivable are piling up, the company is recording sales but not actually collecting the money. Or inventories building up, meaning goods are sitting on shelves unsold. Both of these are warning signs that profits on paper may not be sustainable. On the flip side, a company with modest or even slightly negative net income but strong positive operating cash flow might actually be in excellent shape. It may simply have high non-cash expenses, like depreciation dragging down reported profit, while real cash continues to flow in. Free cash flow is another concept worth knowing here. It is simply cash from operating activities minus capital expenditures, the money spent on maintaining or growing physical assets. Free cash flow is what a company has left over to pay dividends, buy back stock, or reinvest in the business after keeping the lights on. Many analysts consider this the single most honest measure of financial health. And now the question you should be wondering: where does the statement of cash flows fit alongside all the other financial statements, and how do they all connect? Section 5. How it all connects. The statement of cash flows does not exist in isolation. It ties directly to the balance sheet and the income statement in a beautifully logical way. The ending cash balance on the statement of cash flows must match the cash line on the balance sheet. The net income figure used in the indirect method comes straight from the income statement. Every financial statement is a piece of the same puzzle. When you analyze a company, you never want to look at just one statement. A strong income statement with weak cash flow deserves scrutiny. A solid balance sheet paired with consistently positive operating cash flow is a much stronger signal of health. The statement of cash flows is the reality check that keeps everything honest. Understanding this statement gives you a skill that most people, even many business owners, simply do not have. You can look at a company and see beyond the surface numbers to what is actually happening with their money. Closing CTA. And that is the statement of cash flows broken down from top to bottom. If this helped you understand financial accounting a little more clearly, do me a quick favor. Hit that like button. It really does help this channel grow. Subscribe so you do not miss the next video in this series. And drop a comment below with any question you have about cash flows or financial statements. I read every single one. See you in the next video.